Good morning from Tokyo. This is TOITOI Japan Market Radio, February 26, 2026. I'm your host, bringing you today's briefing for global investors tracking Japanese markets. Let's dive straight into the numbers.
Thanks. We're looking at a solid session across the board. The Nikkei 225 closed at 58,753.391, up 0.291%. TOPIX posted a stronger gain, rising 0.816% to 4078.0. The Mothers Index climbed 1.424% to 2350.0, and J-Rights added 0.581%, closing at 2077.5. On the currency side, dollar-yen is trading at 156.102, up 0.142%. Gold in yen terms rose 0.313% to 19,235.0, while crude oil dropped 1.972% to 64.13.
So a fairly constructive picture overall. Now, the headline grabbing attention today is that the Nikkei 225 has hit an all-time closing high for the second consecutive day. That's notable momentum. What's driving this?
It's a combination of factors. First, we're seeing sustained investor confidence in Japanese equities, both domestically and from international allocators. This kind of consecutive record-breaking performance doesn't happen in a vacuum. It typically reflects improving corporate earnings expectations and a broader macroeconomic outlook that's turning more favorable. There's also validation of structural improvements happening beneath the surface, governance reforms, digital transformation initiatives, that sort of thing. These aren't just cyclical trades anymore.
And how should investors think about the implications for the yen and Japanese government bonds?
Well, equity market strength generally supports the yen through what we call risk on sentiment and potential repatriation flows. However, that effect is being tempered right now by global rate differentials, which remain wide. On the JGB side, rising equity markets combined with economic optimism could gradually push the 10-year yield higher. We're likely to see some rotation out of bonds into riskier assets, and inflation expectations may tick up as well. The key question is whether this rally is driven by cyclical momentum, structural improvements, or just technical breakout buying.
Right, and that leads us into the next point. We're also hearing that today's gains were actually trimmed during the session amid renewed expectations of a Bank of Japan rate hike. So the market's trading with one eye on central bank policy.
Exactly. The Nikkei did close at another record, but intraday the gains were pared back significantly. What's happening here is that market participants are reassessing valuations in the context of a potential shift away from ultra-loose monetary policy. The BOJ tightening narrative represents a critical inflection point. For years, ultra-accommodative policy has underpinned both the equity rally and yen weakness. Now, if the Bank of Japan moves toward tightening, that changes the entire calculus. We're seeing diminishing conviction in the upside, even as the index makes new highs.
So we have this tension between record equity levels and rate hike expectations. How does that tension play out across asset classes?
Let's break it down. On equities, the upside momentum is still there, but with increased correction risk. Rate hike expectations will likely cap rallies, particularly in interest rate-sensitive sectors. Banks might benefit from a steeper yield curve, but growth stocks and tech names face headwinds. For the yen, rate hike expectations should be supportive. A higher policy rate improves Japan's relative yield advantage, which unwinds carried trade dynamics and could pressure equity valuations further. And on yields, we should expect JGBs to move higher in anticipation of policy tightening, steepening the curve and raising borrowing costs across the economy.
That's a lot to digest. The key takeaway seems to be watching Bank of Japan communications closely for concrete timing.
Absolutely. Timing and pace will determine whether these record highs mark a peak or just consolidation before the next leg higher. The market is very sensitive to any signals from the BOJ right now.
Shifting to the regional picture, there's a broader positive tone across Asian markets today, and a lot of that stems from Nvidia's earnings beat overnight. How significant is that for Japan specifically?
It's quite significant, actually. Nvidia reported better than expected earnings, and that's triggering broad-based gains across Asian equities, particularly in technology and semiconductor-related stocks. Japan has meaningful exposure here through multiple channels. First, Japanese firms like Tokyo Electron, Advantest, and Shin Etsu Chemical are major suppliers to Nvidia. They benefit directly from strong chip demand. Second, strong Nvidia results improve overall risk on sentiment, which benefits Japan's large tech sector, names like Sony, Renesas, and various robotics and AI plays. Third, there's a spillover effect. Positive tech earnings in the US often lift Japanese counterparts, especially those with exposure to AI infrastructure build-out.
So it's not just about Nvidia itself, but the entire supply chain and sentiment around technology. What does that mean for positioning in Japanese equities?
Semiconductor and tech-related stocks are likely to outperform in the near term. The cyclical recovery narrative supports Japan's export-oriented large caps, and the Nikkei has heavy weighting there. On the currency side, risk on sentiment typically weakens safe haven demand, so we might see modest yen weakness, although the rate hike narrative I mentioned earlier complicates that. For JGBs, global growth optimism tied to strong tech earnings may push the long end of the curve higher. There's also reduced expectation for BOJ accommodation as risk sentiment improves. The bottom line is that Nvidia's beat is supportive for Japanese equities, particularly the semiconductor supply chain. Watch for follow-through in supplier guidance over the coming weeks.
It's interesting how interconnected these themes are. You have the domestic story with the Bank of Japan, and then the global story with Nvidia and tech, and they're both influencing Japanese assets simultaneously.
That's the nature of Japanese markets right now. They're caught between domestic policy normalization and global cyclical momentum. When those two forces align, you get strong moves. When they diverge, you get the kind of intraday volatility we saw today, where gains were trimmed despite positive external news. Investors need to be nimble and think about both dimensions.
Let's pull this together for our listeners. What are the main themes global investors should be focused on as we close out the week?
3 things. First, Japanese equities are making new all-time highs, and that momentum is real, but it's being tested by rate hike expectations. So the rally is intact but vulnerable. Second, the semiconductor and tech supply chain in Japan is getting a boost from strong US earnings, particularly Nvidia, and that's a tailwind for export-oriented names. Third, the Bank of Japan is the wildcard. Any concrete signal on timing or pace of rate hikes will move markets significantly, across equities, currency, and bonds. Global investors with Japan exposure should be monitoring BOJ communications very closely.
Great summary. And as always, we're not offering financial advice here, just bringing you the data and analysis to help you make informed decisions. If you're tracking Japanese markets regularly, consider subscribing to TOITOI Japan Market Radio for daily updates. Thanks for listening, and we'll see you tomorrow.
Thanks, everyone.